Question 1. An insured purchased a whole life policy with a face amount of $100,000. Over the years, the cash value has grown to $20,000. If the insured takes out a policy loan of $15,000 and dies before repaying it, what will be the approximate death benefit paid to the beneficiary? A. $100,000. B. $85,000. C. $80,000. D. $15,000. Answer: B. $85,000. When an insured takes a loan against their whole life policy's cash value, the outstanding loan amount, plus any accrued interest, is typically deducted from the death benefit paid to the beneficiary upon the insured's death. In this scenario, the initial face amount of $100,000 is reduced by the $15,000 loan, resulting in a death benefit of $85,000. Policy loans are not taxable income to the policy owner, but they reduce the amount paid out at claim time, demonstrating a practical use of the policy's living benefits. Always remember that any unpaid loan will reduce the final payout to your loved ones. Question 2. Which of the following statements regarding the incontestability clause in a life insurance policy is most accurate? A. It prevents the insurer from denying a claim due to material misrepresentation in the application after a specified period, usually 2 years. B. It allows the insurer to contest a claim at any time if fraud can be proven, regardless of how long the policy has been in force. C. It ensures that the policy will pay out in all circumstances, even if the insured committed suicide within the first year. D. It applies only to group life insurance policies and not to individual policies. Answer: A. It prevents the insurer from denying a claim due to material misrepresentation in the application after a specified period, usually 2 years. The incontestability clause is a standard policy provision designed to protect the insured and beneficiaries from a claim being denied due to unintentional misstatements on the application after the policy has been in force for a specific period, typically 2 years. This clause provides a level of security, meaning that after this period, the insurer generally cannot contest the validity of the policy due to inaccuracies in the initial application, even if they later discover a material misrepresentation. However, it's important to note that this clause usually does not apply in cases of outright fraud, where the intent to deceive can be proven. This clause helps give policy owners peace of mind that their coverage will be there when needed. Question 3. An individual wants life insurance coverage that provides a guaranteed death benefit, guaranteed cash value growth, and requires premiums to be paid for a limited period, such as 20 years, after which no further premiums are due. Which type of policy best fits these needs? A. Term life. B. Whole life. C. Limited pay whole life. D. Universal life. Answer: C. Limited pay whole life. Limited pay whole life is a type of whole life insurance where premiums are paid for a specified period, e.g., 10 pay, 20 pay, or paid up at age 65, but the coverage remains in force for the entire life of the insured. Like traditional whole life, it offers a guaranteed death benefit and guaranteed cash value growth. The key difference is that the premium payments are condensed into a shorter time frame, making the individual premiums higher than a continuous premium whole life policy but eliminating payments later in life. This option is ideal for those who want to complete their premium obligations while still working. Question 4. All of the following are typically considered non-forfeiture options available to a policy owner upon surrendering a whole life policy, except A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. 1-year term option. Answer: D. 1-year term option. Non-forfeiture options are choices available to a policy owner who decides to discontinue premium payments on a cash value life insurance policy, ensuring they don't forfeit the accumulated cash value. The 3 standard non-forfeiture options are cash surrender value, receiving the accumulated cash, extended term option, using the cash value to purchase a level term policy for the same death benefit amount for a specific period, and reduced paid-up option, using the cash value to purchase a smaller amount of paid-up whole life coverage. The one-year term option is a common dividend option, not a non-forfeiture option. It uses dividends to purchase a small amount of one-year term insurance. Question 5. Which of the following life insurance policy provisions allows the policy owner to name a new beneficiary without the consent of the current beneficiary? A. Absolute assignment. B. Revocable beneficiary designation. C. Spendthrift clause. D. Collateral assignment. Answer: B. Revocable beneficiary designation. A revocable beneficiary designation means the policy owner retains all rights to change the beneficiary at any time without the consent or knowledge of the current beneficiary. This provides flexibility, as the policy owner's circumstances or desires might change over time. In contrast, an irrevocable beneficiary designation requires the beneficiary's written consent for any changes to the policy, including changing the beneficiary, taking a loan, or surrendering the policy, giving them a vested interest. This key distinction affects the policy owner's control over their policy. Question 6. A self-employed individual wants to establish a retirement plan that allows for substantial contributions, offers tax-deferred growth, and permits contributions even if their income varies year to year. Which plan is most suitable? A. Simple IRA. B. 401k. C. SEP IRA. D. Roth IRA. Answer: C. SEP IRA. A SEP IRA, Simplified Employee Pension, is a retirement plan designed for self-employed individuals and small business owners, allowing for significant tax-deductible contributions, typically much higher than traditional IRAs. Contributions can vary each year, offering flexibility to individuals whose income fluctuates, which is a key advantage for self-employed individuals. Unlike a 401k, it is simpler to administer as it does not require complex reporting or testing, making it a popular choice for those working for themselves. Question 7. All of the following are characteristics of universal life insurance, except A. Flexible premiums. B. Adjustable death benefit. C. Guaranteed interest rate on cash value growth. D. Transparent expense and mortality charges. Answer: C. Guaranteed interest rate on cash value growth. Universal life insurance is known for its flexibility, offering adjustable premiums, within certain limits, and the ability to increase or decrease the death benefit, subject to insurability. Its cash value grows based on current interest rates declared by the insurer, which are not guaranteed but typically have a minimum guaranteed rate. This contrasts with whole life, which offers a guaranteed interest rate. The policy's transparency allows the policy owner to see the separate charges for expenses and the cost of insurance, making it easy to understand the policy's moving parts. Question 8. What is the primary purpose of the Medical Information Bureau, MIB, in the underwriting process for life insurance? A. To provide insurers with a database of medical records of all applicants. B. To help insurers detect and deter misrepresentation and fraud in insurance applications. C. To determine the applicant's exact credit score for premium calculations. D. To allow applicants to obtain their personal health information for free. Answer: B. To help insurers detect and deter misrepresentation and fraud in insurance applications. The Medical Information Bureau, MIB, is a non-profit organization that maintains a confidential database of reported medical conditions and other health information about individuals who have applied for life or health insurance in the past. Its primary purpose is to serve as an alert system for member insurers, helping them detect and deter misrepresentation and fraud on insurance applications by flagging inconsistencies. It does not provide actual medical records but rather codes that indicate reported conditions, prompting insurers to investigate further. This system helps keep premiums fair for all policyholders by reducing fraudulent claims. Question 9. An insured has a $250,000 variable life policy. Over time, the investments in the separate account perform poorly, causing the cash value to decrease significantly. What is the minimum death benefit that will be paid if the insured dies? A. The current cash value, minus any outstanding loans. B. The original face amount of $250,000, guaranteed by the insurer. C. The cash value plus the amount invested in the separate account. D. A variable amount based on the performance of the separate account. Answer: B. The original face amount of $250,000, guaranteed by the insurer. Variable life insurance policies feature a guaranteed minimum death benefit, meaning that regardless of how poorly the investments in the separate account perform, the death benefit will not fall below the policy's initial face amount. While the cash value and the overall death benefit, above the minimum, can fluctuate with market performance, the guaranteed minimum death benefit provides a safety net for the policy owner. This feature ensures that a substantial death benefit will always be available, even during market downturns, offering peace of mind concerning the primary goal of life insurance. Question 10. Which settlement option provides for the systematic liquidation of the death benefit over a specified period or in specified installments, with any remaining principal and interest paid to a contingent beneficiary if the primary beneficiary dies before all payments are made? A. Interest-only option. B. Fixed period option. C. Fixed amount option. D. Life income option. Answer: B. Fixed period option. The fixed period option, also known as the installment option for a specified period, allows the beneficiary to receive the death benefit in equal installments over a predetermined number of years. The amount of each installment depends on the death benefit amount, the guaranteed interest rate, and the length of the period chosen. If the primary beneficiary dies before all payments are made, the remaining installments, including principal and interest, are paid to a contingent beneficiary. This option ensures the death benefit is distributed over a set time frame, providing financial stability for a defined period. Question 11. An individual owns a life insurance policy and wants to assign the entire policy, including all ownership rights, to a bank as collateral for a loan. What type of assignment is this? A. Absolute assignment. B. Collateral assignment. C. Revocable assignment. D. Conditional assignment. Answer: B. Collateral assignment. A collateral assignment is when the policy owner transfers some of their policy rights to another party, the assignee, typically a bank, as security for a loan. The policy owner retains ownership of the policy, and upon repayment of the loan, the assignment is terminated. In contrast, an absolute assignment transfers all rights of ownership to another party permanently, effectively selling the policy. Understanding the difference is crucial, as a collateral assignment is temporary and conditional upon a debt, while an absolute assignment is a complete transfer of ownership. Question 12. A policy owner stops paying premiums on their whole life policy. The insurer uses the accumulated cash value to purchase a single premium term policy for the same face amount as the original policy, which will remain in force for as long as the cash value can support it. This is an example of which non-forfeiture option? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Automatic premium loan. Answer: C. Extended term insurance. The extended term insurance non-forfeiture option uses the policy's cash value as a single premium to purchase term insurance with a face amount equal to the original whole life policy. This term coverage will remain in force for a specific period, which is determined by how long the cash value can support the premium. This is often the default non-forfeiture option if the policy owner does not elect another choice, providing the maximum amount of death benefit for the longest possible duration without further premium payments. Question 13. Which statement about the taxation of life insurance death benefits is generally true? A. Death benefits are typically taxable income to the beneficiary. B. Death benefits are generally received income tax-free by the beneficiary. C. Death benefits are always subject to estate taxes. D. Death benefits are tax-deductible for the policy owner. Answer: B. Death benefits are generally received income tax-free by the beneficiary. One of the most attractive features of life insurance is that the death benefit paid to the beneficiary is generally received income tax-free. This means that when the insured dies, the specified amount is paid directly to the beneficiary without being subject to federal, and usually state, income tax. This tax advantage makes life insurance a highly efficient tool for wealth transfer and financial protection for families. However, it's important to remember that while income tax-free, the death benefit may be included in the deceased's gross estate for estate tax purposes if certain conditions are met, such as the insured being the policy owner. Question 14. An individual purchased a life insurance policy and named their spouse as the primary beneficiary. Their child is named as the contingent beneficiary. If the insured and the spouse die simultaneously, who will receive the death benefit? A. The insured's estate. B. The spouse's estate. C. The child, as contingent beneficiary. D. The death benefit will not be paid. Answer: C. The child, as contingent beneficiary. In a simultaneous death scenario where both the insured and the primary beneficiary die at the same time, the Uniform Simultaneous Death Act generally applies. This act assumes that the primary beneficiary died before the insured, meaning the death benefit proceeds would then be paid to the contingent beneficiary. If there were no contingent beneficiary, the proceeds would typically be paid to the insured's estate. This ensures the death benefit is directed to the next intended recipient according to the policy owner's wishes, preventing the funds from going to an unintended party or getting tied up in probate. Question 15. All of the following are common characteristics of group life insurance, except A. Evidence of insurability is generally not required for participants. B. Premiums are typically lower per unit of coverage than individual policies. C. Participants receive individual policies they own and control. D. Coverage is often based on employment or association with a group. Answer: C. Participants receive individual policies they own and control. A key characteristic of group life insurance is that the employer or an association holds the master policy, and the individual participants receive a certificate of insurance as proof of coverage, not individual policies. Unlike individual policies, group coverage is tied to the individual's affiliation with the group, e.g., employment, and when that affiliation ends, the coverage typically terminates, though conversion rights usually apply. Group life policies generally offer lower premiums and do not require individual evidence of insurability, making coverage accessible to many. Question 16. A payer benefit rider attached to a juvenile life insurance policy states that if the payer, typically a parent, becomes disabled or dies, future premiums on the child's policy will be waived. This rider is designed to A. Increase the death benefit of the child's policy. B. Guarantee the child's insurability in the future. C. Ensure the policy remains in force despite the payer's inability to pay. D. Provide an income stream to the payer in case of disability. Answer: C. Ensure the policy remains in force despite the payer's inability to pay. The payer benefit rider is a crucial add-on for juvenile life insurance policies. Its purpose is to ensure that the child's policy remains active and premiums continue to be paid, even if the adult responsible for paying those premiums, the payer, becomes totally disabled or dies. This waiver of premium protects the child's coverage, preventing the policy from lapsing due to an unforeseen financial hardship of the payer. This rider provides peace of mind for parents, knowing their child's insurance protection will continue regardless of their own health or income. Question 17. An individual purchased a non-participating whole life policy. Which of the following is true regarding this policy? A. It will pay dividends to the policy owner. B. Its premiums are typically lower than a comparable participating policy. C. Its cash value growth is tied to the insurer's investment performance. D. It can be converted into a term policy. Answer: B. Its premiums are typically lower than a comparable participating policy. A non-participating life insurance policy does not pay dividends to the policy owner because it is issued by a stock company that focuses on generating profits for shareholders. Since these policies do not share in the insurer's surplus, their initial premiums are typically lower than those of participating policies, which are issued by mutual companies and are designed to return excess premiums to policy owners as dividends. This difference in premium structure is a key distinction between these two types of policies. Question 18. An agent recommends that a client surrender an existing life insurance policy and purchase a new one, stating that the new policy offers better benefits and lower premiums. This transaction is specifically known as A. Replacement. B. Conservation. C. Rollover. D. Rebating. Answer: A. Replacement. Replacement refers to a transaction in which a new life insurance policy or annuity is purchased, and an existing policy or annuity is terminated, lapsed, surrendered, converted, or reissued. This practice is heavily regulated because it involves potential disadvantages for the policy owner, such as new contestability periods, loss of accumulated cash value advantages, or higher premiums due to age. Insurance regulations require specific procedures and disclosures for replacement transactions to protect consumers. Question 19. The policy provision that states the applicant's statements are considered representations, not warranties, and that the policy, along with the application, constitutes the entire contract is known as the A. Free look provision. B. Entire contract clause. C. Reinstatement clause. D. Insuring agreement. Answer: B. Entire contract clause. The entire contract clause stipulates that the life insurance policy itself, along with the attached application, constitutes the entire agreement between the policy owner and the insurer. This means that nothing outside of these documents can be considered part of the contract, preventing either party from making claims or statements not included in the written agreement. This clause protects both the insured by ensuring all promises are documented and the insurer by preventing undisclosed information from altering the contract's terms. It is fundamental in ensuring clarity and finality regarding the policy's terms. Question 20. Which of the following situations would most likely result in a life insurance claim being denied due to the suicide clause? A. The insured dies in an accident after owning the policy for 5 years. B. The insured commits suicide 6 months after the policy's issue date. C. The insured dies from natural causes 1 year after the policy's issue date. D. The insured commits suicide 3 years after the policy's issue date. Answer: B. The insured commits suicide 6 months after the policy's issue date. The suicide clause is a common life insurance policy provision that typically states if the insured commits suicide within a specified period, usually 1 or 2 years, from the policy's issue date, the insurer will not pay the death benefit. Instead, they will usually return the premiums paid to the beneficiary. If the suicide occurs after this exclusion period, the full death benefit is generally paid. This clause is designed to prevent individuals from purchasing a policy with the intent of committing suicide shortly thereafter. Question 21. Which annuity payout option guarantees payments for the life of the annuitant and, if the annuitant dies before a certain number of payments, e.g., 10 or 20 years, have been made, the remaining payments are guaranteed to a beneficiary? A. Straight life income. B. Life with period certain. C. Refund life annuity. D. Joint and survivor life annuity. Answer: B. Life with period certain. The life with period certain annuity payout option guarantees payments for the entire life of the annuitant, ensuring they will never outlive their income. Additionally, if the annuitant dies before the period certain, e.g., 10 or 20 years, has elapsed, the remaining guaranteed payments will be paid to a named beneficiary. This option balances the security of lifetime income with the assurance that a portion of the payments will go to heirs if the annuitant dies prematurely, making it a popular choice for those who want both personal and familial protection. Question 22. All of the following are common uses of business life insurance, except A. Funding buy-sell agreements. B. Providing key person coverage. C. Covering unemployment benefits for former employees. D. Supplementing executive retirement plans. Answer: C. Covering unemployment benefits for former employees. Life insurance is a crucial tool in business planning, serving several purposes, including funding buy-sell agreements to ensure a smooth transfer of ownership upon a partner's death, providing key person coverage to protect against the financial loss caused by the death of a critical employee, and supplementing executive retirement plans. However, life insurance is not designed to cover unemployment benefits. Those are typically managed through state and federal unemployment insurance programs. Question 23. A prospective insured has a significant hazardous hobby, such as skydiving. When applying for life insurance, what might an underwriter typically do regarding this risk? A. Decline coverage entirely, as the risk is too high. B. Issue the policy at standard rates, as hobbies are not considered. C. Issue the policy with an exclusion rider for death related to skydiving or charge an extra premium. D. Issue a temporary policy until the hobby is discontinued. Answer: C. Issue the policy with an exclusion rider for death related to skydiving or charge an extra premium. When an applicant has a hazardous hobby, underwriters typically classify the risk as substandard, which means the applicant presents a higher risk than average. To account for this increased risk, the insurer might either charge an extra premium, also known as a flat extra premium, or attach an exclusion rider. An exclusion rider would state that the death benefit will not be paid if death results directly from participation in that specific hazardous activity. This allows the insurer to provide coverage while managing identifiable elevated risks. Question 24. What is the primary purpose of the grace period provision in a life insurance policy? A. To allow the policy owner to surrender the policy for its cash value without penalty. B. To give the policy owner extra time, typically 30 or 31 days, to pay an overdue premium while the policy remains in force. C. To permit the policy owner to change the beneficiary without additional paperwork. D. To waive premium payments if the insured becomes totally disabled. Answer: B. To give the policy owner extra time, typically 30 or 31 days, to pay an overdue premium while the policy remains in force. The grace period is a standard policy provision that provides a specific time frame, typically 30 or 31 days, after a premium due date during which the policy remains in full force even if the premium has not been paid. This period allows the policy owner additional time to make the payment without the policy lapsing immediately. If the insured dies during the grace period and the premium is unpaid, the death benefit will still be paid, usually with the overdue premium deducted from the proceeds. This provision is a crucial safety net against accidental policy lapse. Question 25. An individual wants a life insurance policy that offers the potential for significant cash value growth tied directly to the performance of an equity index, such as the S&P 500, but also provides a guaranteed minimum interest rate, preventing losses. Which policy type best fits this description? A. Universal life. B. Variable life. C. Indexed universal life. D. Term life. Answer: C. Indexed universal life. Indexed universal life, IUL, insurance is a flexible premium universal life policy where the cash value growth is linked to the performance of a recognized equity index, such as the S&P 500. A key feature of IUL is that it offers the potential for higher returns than traditional universal life policies, while also providing a guaranteed minimum interest rate, a floor, that protects the cash value from market downturns. This combination allows for participation in market gains without the risk of actual losses to the principal cash value, appealing to those seeking growth potential with downside protection.